Most people in the UK assume you need thousands of pounds sitting around before you can start investing. That belief works out rather nicely for the investment industry because every month you spend waiting to have enough. They're the ones making money regardless, and in reality, £100 is enough to get going, and it's worth understanding exactly how by the end of this. Start with the tax wrapper, because everything else builds on top of it. In the UK, that's a stocks and shares ISA, and the reason it matters is that any profit made inside one is completely free of tax. No capital gains tax, no dividend tax, nothing owed to HMRC at all. You can pay in up to £20,000 a year. Opening one takes about 10 minutes online, and most providers won't even charge you for the privilege. Invest outside an ISA instead, and you could end up handing over 20% or more of your gains once HMRC gets involved, which adds up fast over the years. So the ISA is step one. Think of it as the container everything else sits inside. From there, you need somewhere to actually hold it, which means choosing a platform. There's no shortage of options. Trading 212, Vanguard, Hargreaves Lansdown, Free Trade, Dawdle, AJ Bell, and honestly, the specific name matters less than two numbers buried in the small print: the platform fee and the dealing charge. Some charge a percentage of your portfolio each year. Vanguard, for instance, takes 0.15%, capped at £375. Others charge a flat monthly fee instead, like Free Trade's £4.99 a month for its ISA. Trading 212 charges nothing on either front, which is a big part of why so many beginners end up starting there. When you're only putting in £100 a month, the difference between a 0.45% fee and a zero-fee platform sounds trivial at first glance, but stretched across 20 years of steady contributions, it can quietly cost you thousands. Then comes the question of what to actually buy with that £100, and the honest answer is not individual company shares, at least not yet. The better move for a first investment is an index fund, or ETF, that tracks the market as a whole rather than betting on any single business. The Vanguard FTSE All-World ETF, ticker VWRP, is a good example. One fund, holding over 3,600 companies spread across the entire global economy. Buying it means backing the idea that global capitalism keeps expanding rather than trying to guess which individual company will win. Global markets have historically returned somewhere around 7% to 8% a year over the long run, while the S&P 500 alone has averaged closer to 10% over the last century. A global tracker trades a bit of that upside for a lot more diversification, and picking winners stops being something you need to worry about. Which brings us to the part that actually does most of the heavy lifting: compound interest. Put in £100 today and keep adding £100 every month, and assuming markets return roughly 7% a year on average, after 30 years, you'll have contributed £36,100 out of your own pocket. Your portfolio, though, would be worth somewhere north of £122,000. That difference, something like £86,000, isn't money you put in. It's money your money made on its own, in the background, while you were doing anything else with your life. None of this requires a finance degree or any particular talent for reading a balance sheet. What it actually takes is an ISA, a platform that isn't quietly eating your returns, a broad index fund, and the discipline to keep contributing regardless of what the market's doing that week. The part that trips most people up isn't the investing itself, it's the waiting, convinced that £100 doesn't count for much, when the real cost is every month that money spends sitting in a current account instead of growing. Open the account, set up the direct debit, and everything after that is mostly patience.